Good evening, everyone. I'm going to introduce myself one more time for the audience. My name is Shat, and I'm an investment analyst at 249 Startups. I work with Sudanese entrepreneurs across different sectors. I support them with investment readiness and throughout our different programs here at 249 Startups, with a specific focus on renewable energy. Obviously, I welcome all of you to the Beyond Capital Summit, where we have a deeper conversation about various topics, including the one we're going to be discussing today, which is titled Deploying Capital in Fragile and Frontier Markets, discussing specifically tactical due diligence and deal structuring. We will definitely share lessons and examples that illustrate how due diligence can be applied effectively in emerging markets alongside fragility contexts as well. Our panelists for today are Ghadir Mahgoub from Alchemist Doha. We have Sali Alagab from Shorooq, and we have Sina from GIZ. Feel free to introduce yourselves to the audience, starting with Ghadir.
Hi everyone. My name is Ghadir Mahjoub. I work as a director of investments with Alchemist Doha. It's a fund based in Qatar. We're part of the Alchemist Accelerator San Francisco, and we've been operational for almost 2 years now, operating as a pure VC here in Qatar. And very nice meeting everyone.
Sally.
Awesome. Welcome, guys, to the panel. Super excited to kind of be joining the discussion with these amazing ladies and over to you guys as well. I'm Sali Elagab. I'm part of the investment strategy team at Shorooq Partners. We're a regional VC based out of the UAE, but really spread out across the region, Egypt, Saudi, Pakistan, and Korea as well. Managing over $500 million of assets under management across multiple platforms and mainly investing in seed to Series A tech companies across multiple sectors. So looking forward to the discussion.
Thank you, Sally. Sina?
Yeah, so my name is Sina. I work for GIZ, and I have been until the end of September this year working for a private sector development project for GIZ Sudan. So we also went through the different stages from, military coup to outbreak of the war to adaptation of our project following our partners to neighboring countries. So I'm very happy to be part of this panel.
Thank you so much. I think we'll start our first round of discussions when we speak specifically about risk, due diligence, themes such as operating contexts in both areas with fragility and in emerging and frontier markets as well. I think the first question is for you, Sally, and I just want you to draw from your experience working with entrepreneurs across the MENA regions and also outside the MENA region. How specific?
So I think you cut off there, Shahad, for a second, but I think just to kind of, if I was to kind of gather in as well, obviously a lot of kind of the investments that we do at Shorooq Partners is across different emerging markets, right? So these are markets that are known to be quote unquote risky, right? I think for us, and a good way that we kind of think about what that risk is about and the risk appetite in VC, because at the end of the day, anyone that is investing in early stage tech companies understands that it's risky inherently, right? So it's the nature of VC and it's the nature of early stage specifically, right? I think one way to kind of look at risk is to think about asymmetry, right? So at the end of the day, as a VC, you're purchasing equity into the company, a potential of the company. And whenever there is asymmetry between what is being priced in the deal or the company versus the risk, and the risk that essentially you're talking about market risk, team risk, execution risk, and we can kind of get into these as well. But whenever there is asymmetry between those two kind of components, this is essentially when you start to see either capital deployment being kind of slower in certain markets. maybe terms of deals being a lot more aggressive towards founders or so on and so forth. And that is really just all comes in as a way for you to be able to kind of build back that symmetry or build back that balance between how deals are being priced and the nature of the market. And I think one way to really be able to draw that balance is to actually have a very, very good understanding of the market that you're investing in, right? So if I was to draw an example of Shorooq Partners, we have teams that are on the ground across all 6 core geographies that we invest in, right? So we believe that no matter what year we're in, you cannot invest in Egypt unless you're on the ground in Egypt. You cannot invest in Sudan unless you're in the ground in Sudan, understanding exactly how things run. That helps you mitigate and actually build context around what really is that risk and how big is it and how kind of fundamental it is to the deal and to the company, essentially.
Okay, yeah, definitely. And I think when we speak about risk, we also immediately go to the purpose of due diligence is to actually understand the underlying risks in these markets through assessing different companies. I think I'll ask Ghadir also about her experience on that. What factors do you think elevates the company's risk profiles the most? Whether it's team composition, governance, or market exposure, regulatory context, or is it operational maturity? So what kind of risks do you think
والله يعني
elevates
when
this
we look
company?
at emerging markets, I mean احنا كمان at Alchemist Doha the focus is emerging markets and it's all of the above, right? But most importantly, yes, it's the regulations, the compliance, and in fragile environments in general, يعني paperwork may not exist the way we want it to. And at the fund I work at, I actually lead on like deal executions, like due diligence, and the portfolio monitoring as well. So it gets a bit, yeah, يعني systems may have may not look the way you expect them to, and the formal process may never exist to begin with. So we always try to, when we look at companies in these kind of markets, instead of asking just for documents, we try and look for, I would call it reality. Are there real customers? Are they really paying? Is there progress happening, like month over month? We start to ask different questions because you can't assess companies the same way you assess, in the Silicon Valley, for example, when their issues are growth and this and that. In markets like Sudan or markets like emerging markets in general, a founder wakes up thinking actually about logistics to begin with, and then payments, and then safety, and continuity before they even think about growth. So as an investor, we have to, in a way, shift that like mindset as well, just a little bit to try and understand the situation before we decide how are we going to assess this company, to begin with. So we need to spend more time with founders like this, really. And then I try to really listen to the setbacks that they are going through before being able to assess. And then, صراحة, most importantly, being able to assess how they make decisions when things go rough.
Yeah.
I think that's a very important one. Then being, consistent, integrity, and the learning speed, because we do expect things to change, things to shift. It's all about how fast they respond and how dynamic they are.
That's pretty much accurate. I think that takes me also to the next question I want to ask to Sina. From your experience in Sudan's private sector, so what do you think is the most, what are the challenges basically that these businesses face? And what kind of programs have you designed to manage these challenges or to address these challenges?
Maybe let me just pick up where Ghadir left off earlier, because it was quite interesting that you said that about formal compliance, versus investability in a sense, because I think that's actually at least from my experience, one of the core mismatches, or that the assumption that formal compliance equals investability, that I think is a mismatch as such. I think the situation in Sudan, if you take that as a background, the disrupted institutions, markets, and documentation systems, have all been, disrupted. But many investors, we had the feeling, were actually expecting, polished documentation, stable governance structures, predictable growth trajectories. But of course, Sudanese startups are operating, like Ghadir said, in an environment shaped by conflict, displacement, and institutional collapse. So I think what may look like informality is actually often, I think, adaptive resilience. Yeah. I also wanted to raise another point, which Ghadir also touched upon. It's, I think there's a gap in expectations around risk ownership. Investors, or let's say the majority of investors often assess risk at the firm level alone, right? While Sudanese startups are navigating systematic risk. I mean, they are already absorbing significant political, security, and currency risk. I think what GIZ, or at least through our project, what we had observed is that operational resilience and local embeddedness adaptive leadership are often actually stronger indicators of viability than formal structures that cannot realistically be maintained under, the current conditions. And I think that's where basically then the other mismatch comes up. It's the speed and scalability, because I think investors often expect rapid growth, while at least I would say, entrepreneurs are focused in such a situation mainly on survival, continuity, and protecting core operations. So I think in fragile contexts, like, maintaining operations itself is a performance indicator, actually. And I think that's where, GIZ, as a development actor, we have a longer term longer term system stabilization goals, right? So I think for us as a development organization, I think this bridging the gap is essential to avoid excluding viable enterprises simply because, the environment is unstable. And GIZ has, or the way we had basically reprogrammed our project was very much catered towards that. So we had adapted to the situation after the outbreak of the war, looking at what is actually needed on the ground. How can we also ensure business continuity? I mean, it was, I would say we were lucky enough that we had that flexibility. Development organizations are not normally, they're quite rigid when it comes to like project design and everything. So there's not a lot of space to kind of like maneuver out. But given the situation, and I think also the understanding we had of Sudan and our project and with our partners made that possible. So I mean, I don't want to name like specific activities we did, but like, they're numerous, but we were supporting, we adapted to the situation in a pragmatic way and followed our partners to neighboring countries while also maintaining operations in Sudan.
Interesting. I guess, prioritizing continuity as well in this context is essential. And I feel like the risks or the challenges that you've spoken about also are context driven rather than it's a company specific risk. So I want to also ask Sally to like highlight certain things. So when you identify such risks or like context-driven risks rather than company-specific risks, how does that influence your decision making, in your team or generally, like when you're assessing potential investment or potential deal?
I think that's a very good question because I think the first step there is to really fully understand the context, right? So if we talk about fintechs, for example, right? Fintechs in Saudi are very different in nature from fintechs in Egypt, in Sudan, in Nigeria, so on and so forth, right? And so as an investor, I actually believe that it's our duty as an investor to, first of all, understand the context in the local market very, very well, right? Otherwise, everything can seem scary and everything can seem uncertain and everything can seem risky, right? You only build conviction through knowledge and understanding the data that's being presented in front of you. I think the other thing that comes to mind a lot, and we've seen this in a lot of deals that we've worked with, is context also means who's behind the deal, right? Today in a lot of emerging markets, these are markets that are very much relationship driven, right? So beyond product, beyond tech, beyond opportunity, understanding really where does the founder kind of sit within the social construct of that market, right? Are they able to be presented as a credible founder or a credible innovator in that market? How are they kind of positioned within that ecosystem? And thirdly, and most importantly, and I think, Sina, you pointed out to this, is how resilient is this founder, right? That comes in extremely important and can, some people would argue, is the important kind of key factor is how resilient are you as a founder? Because if there's one thing that is for sure, if you're operating in an emerging and perhaps volatile market, is that things will go sideways. Right. That is the only certainty actually that you do know, funnily enough. So when things do go sideways, right, how do you react as a founder, right? How do you, number one, maintain whatever you can maintain, right, and leverage it to actually perhaps even get ahead of the game, not even just maintain operations, but actually leverage it as an opportunity. But also, how do you then turn into your support kind of circle, be that investors, advisors, etc., maintain the transparency that you need to, because when things go sideways, it can seem scary. And we've seen founders perhaps maybe shy away from being fully transparent during hard times, right? So how do you own up to that fact and the reality of what is happening, but also be extremely creative and resilient in terms of how you plan to deal with it, right? So looking into all of that, I think in having a good understanding of the local market and the context beyond that, I think as an investor allows you to then make, I think what you're looking for is not necessarily a certain bet, right? But hopefully the right bet, right? So then you're not necessarily looking for everybody in the IC to be on the same page, because by nature of how ICs are made, people have different kind of risk appetite. So that's not the objective there, but at least be able to kind of make a bet on companies that we know will be resilient and will actually end up transforming a lot of these emerging markets.
Definitely. I think also going, as you mentioned earlier, being on ground gives you that insight in depth. I feel like also shedding on your experience, Ghadir, yani with the Alchemist, as you also work across different markets and ecosystems. How does context, as we're speaking, shape the due diligence approach itself, like due diligence processes, requirements, documents, etc.?
Yeah. So just like Sali mentioned, honestly, obviously when you conduct due diligence for a startup that's in a less, I would say, structured environment, less structured market, then it becomes the factor of assessment of the founders, the personality, the consistency, level of responsiveness, like the learning curve as well. And then they become one of the critical, I would say, DD signals, right? We try to expand it a bit beyond the company, obviously. In certain cases, the personal risk, geopolitical risk, obviously, and then currency risk, if it exists in such a transaction. We always also raise questions such as if whether the founder is ready to move if need be, whether the founder is ready to, for example, move like physically, move the IP, move even the mechanism of which they book their revenue, for example. So all of these questions we raise once we assess companies in that sense. And at the same time, obviously, once we structure such investments, we tend to use like additional, I would say, ways to mitigate the risk to some extent, whether it be like side letters or just basically tranche investments based on certain milestones, or at least restructuring. Like sometimes we go for actually something a bit more extreme. We request some restructuring of the corporation itself, but this does not happen very often. But these are all methods we can use to still not try to discipline the company. It's more to try and basically set things in a way that we try and mitigate as like certain risk, or try to manage the complexity of a certain deal. For Sudan specifically, honestly, investors just need to keep an open mind and acknowledge that the operating risk is not, as she mentioned, it's real, it's there, it's happening. It's whether you get impacted, significantly or not. But this also comes with a good potential for upside, So investors need to keep an open mind in that sense, and to try and, like mitigate the risk by just, like having some sort of a good structure, alignment, and as Sally mentioned, the transparency is very important. Having that openness with the founder, with the company, and the companies knowing that they can come to these investors when things go sideways. I'm not going to say if. So not just, not through excluding the fact that there's complexity and whatnot. No, just being open about it, dealing with it as it happens, and at the same time being able to adapt, as needed. So these are the methods we typically use.
Interesting. All right. So do you definitely see differences between operating in the MENA region and in Sudan? What is different in the MENA region than in Sudan, for example? Like what could be improved in the context of Sudan, where you can see in the MENA region in terms of due diligence requirements, etc.?
So in the MENA, look, I mean, most of our experiences in the GCC specifically. So we do operate as, the institutions here are quite strong. I mean, I could speak for Qatar. I'm guessing it's the same for the UAE and Saudi as well. The regulations are very clear, and the capital is available, but obviously the risk appetite is not there. I think at least for being operative in Qatar here for a few years. So it's there's definitely that difference, but at the same time, we do see the push, we do see the appetite in the GCC region in general to invest in these emerging markets, structure the deals in a way that, that would protect to some extent the downside, but at the same time be able to basically benefit from the upside when it happens, and be able to support when you support companies from emerging markets, the impact is definitely much more significant, You do see it, like you see it live, you see it happen. Unlike when you invest in, I would say, like more developing nations or even more mature companies, let's say. So it all comes down to what the funds are looking for, or what investors are looking for specifically. But lately, at least being a part of this ecosystem in Qatar and our interactions with the region, we are definitely like heading towards being investors with a more open mind to these kind of risks. It's just a matter of how do we tailor things, I mean, we don't have the advantage of being, for example, in the countries that we invest in. But we did actually invest in a few countries across, a few companies across different countries over the past few months. And we just, we basically do our due diligence in a more enhanced manner, and at the same time, just treat these investments a bit differently, and hope for the best, Yeah.
Interesting. I think, definitely the goal is to build investor confidence and supported by doing on-ground due diligence where the requirements that the Alchemist, for example, sees as a priority. I think I'll ask also Sina on
Shad, sorry, before you ask, Can I just pick up on two things?
Yeah,
The one
definitely.
question,
Feel free.
basically,
Yeah.
one question you have asked, how does context shape due diligence? And then one point which Ghadir mentioned, transparency. I think that's quite interesting because in terms of like how does context shape due diligence, I think there's a buzzword which should be in everyone's mind. I think it's flexibility, right? I think it's flexibility in the sense how due diligence is applied rather than whether it is applied. And I think at least like from our experience, maintaining standards while adapting methods, such as, I don't know, triangling information through local partners or field verification is more effective than, for example, lowering requirements. Just to that point. And then transparency, that's also quite important. I think I think credibility starts with transparent communication, right? I mean, entrepreneurs should clearly explain how conflict or a fragile situation affects their operation and what practical measures they use to manage those risks, right? Rather than, for example, downplaying those challenges. Yeah, so sorry I interrupted you, but I just wanted to pick up on those 2 points.
Yeah, I actually wanted your insights on the context as well and how you think that matters. I think I'll also continue with asking Sally about also the entrepreneurs that she's been dealing with. A lot of entrepreneurs in Sudan find it quite intimidating when they hear the word or the phrase due diligence. And whenever we explain the different due diligence processes, they feel drained already before they submit anything. So what advice can you give to entrepreneurs in Sudan or in emerging markets where risk is inherent to prioritize rather than starting all at once? So what's your advice on that matter?
So this is actually, weirdly enough, Shahad, one of the things that's very close to my heart because I did wear a founder hat once, right? And so I understand the apprehension. I understand kind of perhaps even confusion, the lack of clarity around, okay, how do you actually deal with VCs? How do they want? One of the key things that came out for me when I started kind of getting into the VC space was that actually a lot of this apprehension comes from the fact that people don't fully understand how VCs work, right? When you don't understand something, it just seems intimidating right off the bat, right? So my first advice is actually to go out and try to understand how VCs work. Ask someone, feel free to connect with me, ask me, I'm happy to yap about this for hours on end. But once you do, you start to understand how VCs think, right? And so now it stops being personal. It stops being someone taking a stab at your business or your product or your market. It becomes very objective because at the end of the day, investors do have a fiduciary duty to their LPs, right? This is where essentially if you were to kind of align priorities and fiduciary duties, it is essentially to the LPs. These are the people that we vow to bring back some returns to. And so it stops being personal on that front. So that's one, I think this is the first thing that I would advise founders to do. Founders that have been able to do this have found it a lot easier to at least speak the same language that VCs or investors do because you understand how they think. It also enables you to pinpoint and identify who's a good VC from a bad, I don't want to say a bad one, but who's a good fit from a bad fit for you and for your business, right? And I think that's another kind of important thing to kind of keep in mind. Not all money is good money, right? I don't think that's the way to kind of think about it. Especially, I think in fragile markets or emerging markets, having strategic backers and strategic investors that will really be by your side throughout the journey, long-term investors, is far more important than the ticket size, far more important from how flashy the name is or is not, and so on. The second bit I think after that, and just to nudge on something that Ghadir mentioned, a lot of VCs actually, when they do have conviction in a deal, they will go the extra mile to help them either restructure or put in certain things in place before they sign, and it's part of kind of what that side letter is, and so on and so forth. And I think for some founders, maybe understandably, it feels like, okay, we're being restrained or we're being asked to do very specific things. I would actually ask founders to reframe the conversation and actually think of it as a step to prepare for fundraising for your next round, actually, because someone is actually taking the time and telling you, okay, these are all the things that you need to get in order in your house today. Right. Yeah. But once you do, actually, it's going to be a lot easier for you to welcome in other investors, have these similar conversations down the line. So if anything, it's actually, if I had a VC that would kind of sit down and tell me all the things that I need to fix about my business, that's actually a blessing. You know, I would listen very, very carefully and take that in. That being said, I think the last thing, and not to kind of paint VCs in a very kind of pink and rosy pictures, there's pros and cons to each. And one of the first things that I tell founders is, I think in today's world, there's a lot of noise and flash around this company raised X million, or this company got into YC, or so on and so forth. Not all businesses are VC backable businesses. And there's absolutely nothing wrong with that. Some of the best businesses that we've had in our countries are not VC backable. Right. And there's no right or wrong, right? It's simply just a different kind of business. So I think another honest conversation that founders need to have with themselves, which is, okay, does it actually make sense for my business to go out and raise from VCs? Do I need to look at strategics? Do I need to look at other sources of funding? And what makes the best kind of option for me? Because truth of the matter is, it's not always VC money that makes sense for all businesses, even if they are tech businesses.
Absolutely. Yeah, I feel like also founders can be quite protective of their business. So when you're recommending a restructuring, or you're recommending that they should sort out this or that, they are sometimes reluctant, but maybe, yeah, they do need to consider whether the VC is the right way for them. I think I'll ask also Ghadir on that domain. I feel like most of Sudanese founders or entrepreneurs, when they left Sudan after the war, they went out to the different countries, whether it's the UAE or Saudi and other countries in the MENA region. What advice would you give them if they wanted to establish in the MENA region in terms of their due diligence, paperwork, etc., to basically succeed?
Yeah, so I'll just build on what Sali has mentioned. I think he mentioned really good points. And yeah, it first starts with whether, because I've seen it a lot in Qatar. I mean, before my role at Alchemist, I was part of Qatar Development Bank, which runs multiple programs as well. So it's not just, there's a VC arm, but then there's other kind of financing, there's green financing, there's all sorts of things. And I did meet a few Sudanese companies or Sudanese founders that were looking to set up companies. And that question was the first question I asked: is your business VC related? Are you in tech? Or are you more towards, trade? Or, are you more of a company that qualifies for example, the free zone, I would say, like setup and, what kind of business do you classify as, first of all? And then who are your partners in that ecosystem? Who would be your ideal partners, right? Then you choose 2 or 3 and then start there. And then once you confirm that you're meant to speak to VCs, then the next question becomes exactly what Sally mentioned, looking for smart money, right? You don't just want any fund. You don't want like just an investment. And then founders tend to be very, I would say, stuck on the whole like valuation discussion. No, I want this, I want that, versus, who's the investor that I want by my side? Will they take me from point A to point B, and how fast will that, like happen? And I think these are the most important things, honestly. And when it comes to due diligence, they just need to come with an open mind. Most funds here, as Sally mentioned, are either like LP backed, or in our case in Alchemist, we're actually backed by the Qatari government. It's an indirect relationship, but we're backed by the government. So for us, it's even a little bit, I would say, it comes with a different mandate, more of a developmental mandate, more of a mandate related to impact as well. So our asks, they tend to be a bit, I would say, different. For example, when we invest, we do require for the technical founder to come to Qatar and spend a few months a year, which might not sound like such a bad thing, but it's one of the requirements, right? And we do sometimes feel like founders think that this is us micromanaging when it's just the mandate, that we're serving. The mandate came from a very specific reason. For example, because we're backed by an R&D agency in Qatar. They do want the technical person here, not the salesperson, not the CEO. And it has proven to be effective in a specific way that, again, the government envisioned, and we're here trying to make it happen. So just coming with an open mind, understanding this venture capital you're dealing with, consider due diligence phase as your engagement period. You know what I mean? Ask all the questions. You have all the right to DD your investors as well. It's not just them. You have all the right to ask the questions, see if this is the right fit. And investors on the flip side, they should be just able to not necessarily change their standards of due diligence, as Sina was mentioning, but just changing the evidence you're willing to accept, just to try and tailor that to the specific startup you're speaking to the specific founder, where they're coming from, and understanding the restrictions that they've dealt with, to get to where they are. I think that would be my main, my main advice to to founders that are coming to this region.
Yeah, that's great. I really hope they're taking notes, honestly, because obviously the same way they're getting checked, let's say, they should ask investors as well on the other side. And basically they're going to be involved with them in the business, so it goes both ways. They should be able to ask questions as well. I think Sina,
just one thing. So instead of just for founders, so instead of when Sali was mentioning DD being a process that founders always push back on, or it's better to always, for founders, to try and think of ways to actually articulate and explain why they make the choices they made, rather than just be defensive and push back in general. I think it makes all the sense in the world, when you explain why you made certain decisions and what were the drivers behind it, rather than just being all protective over what you've done and just not explaining, things the way you should. So it comes back to transparency after all.
Yeah. I think earlier as well, you mentioned responsiveness as well when assessing businesses. I feel like at 249 startups, we weigh this extremely highly. The responsiveness, the enthusiasm of entrepreneurs actually makes a huge difference as well, as part of the formal due diligence processes. I think, Sina, I also want you to comment on that aspect from a development perspective. Like what do you see development institutions can do in that domain when you're dealing with startups in conflict zones and they want to leave, let's say, to move to other regions? Is flexibility the goal? And how do we ensure flexibility without risking complying to certain things as well?
Well, let me maybe first start that I think ecosystem actors are in such an environment are really no longer optional. They are, I think, the infrastructure of the private sector, right? For example, accelerators, local partners, also humanitarian supply chain actors or diaspora networks, have kind of become, I think, the connective tissue holding markets together, where former systems have broken down. To the part of your question, when they're moving abroad, I think leveraging networks is key. For example, participation in GIZ-supported programs or activities, or reputable accelerators, or again, diaspora-backed platforms really provide, third-party validation in a way, right? And I think also reduces perceived risk. Yeah.
Thank you so much. I think also
sorry, there was one part of the question, I think, how development actors can then support also, right? I think, because we're perceived as not only us or development organization as such, GIZ, but also again, accelerators or trusted local partners like 249, right? I think we are in a way neutral brokers in such settings, so I would even call it maybe risk translators, because connecting private investors with credible pipelines, for example, supporting ecosystem actors and absorbing early stage risk through catalytic and blended finance instruments, for example. Yeah, sorry, I interrupted you again.
Yeah, that's very valuable, because I wanted to know exactly what kind of methods you implement when dealing with such contexts as well. I feel like startups needs to also be adapted or introduced to certain methods when they're dealing with challenging environments like Sudan. How can this is a general question for all of you, but I'll ask Sali first to answer first, and then Ghadir, and then Sina. How can we ensure that these startups or these entrepreneurs are assessed fairly, given that there is systematic inherent risk? Sali, please feel free.
Definitely. I think I 100% agree with you that there are inherent kind of, I would say, disadvantages, right? Others might argue and say there's actually a very big opportunity here, right? And the right investors are actually excited about these opportunities a lot more than discouraged by the risk. I think, and this is, I would say, part of this also falls as a duty to the founder to also educate the right investors, not to benchmark them, or at least to benchmark them against the right category, right? Meaning that you cannot benchmark a startup that is building out of Sudan, Kenya, Egypt, etc., to one that is out in Silicon Valley, right? Or one that is out of Europe. You need to be able to benchmark them from a valuation perspective, from a team, from an opportunity size, from a risk perspective. Inherently, obviously, a lot of these companies will be a lot riskier than companies that you would look at from Europe or US or even the UAE or Saudi, right? So what you're benchmarking against, and that kind of, I would say, base point needs to change. And if the investor is not there, then I think it's also part of the conversation that founders have with VCs to actually help educate them around what really is the right benchmarks, right? So that's one side there. I think one thing that Ghadir mentioned as well, and this takes flexibility on both parts, is to start to also think creatively around how the deal is constructed, right? Do we want to do safe and warrants? Do we want to tranche this to kind of mitigate execution risk? Do we want to make sure that we kind of have to have strategic investors as part of the round? So I think thinking creatively on different ways to mitigate the risk and change the narrative. I think if there's anything that I would like founders to kind of take away from today is to not fall under kind of the frame of thinking of, oh, we're building in a volatile market. No one understands this. We would never be able to raise from VC. So like that is a downward spiral, right? You don't want to go there. I think the right founders will be able to position themselves the right way, attract the right investors, and educate them in a way that will actually help them become a lot more confident and a lot more, I would say, excited by these markets. I've seen this happen firsthand in an IC, right? Where the conversation started about everyone not understanding what's happening in Sudan. Is it even operating? Isn't there like kind of violence happening everywhere? And by it did take like 4 hours, but 4 hours later, it was like, oh wow, actually, this can be big. This can be huge, right? But that takes, I think, everything that was discussed today and everything that everyone else kind of mentioned for that to happen. So to kind of answer that question, I think there's a few elements there. I don't want to hog the conversation, but really being able to benchmark against the right players, being able to kind of think creatively on how to construct the deal so that it works for everyone involved as well. And that helps kind of, I would say, bring back the balance or the asymmetry that we also talked about in the beginning.
Yeah, that's absolutely right. Interesting. Ghadir, do you have any follow-up comments on that?
Well, so for founders, I would just like to really maybe say it again, but in a different way, is that if you don't look familiar to investors in the way you're set up and the way your company operates, then you need to work really hard on performance. You need to work hard on a story. You need to work hard on how you're seen by investors, right? That doesn't mean do something different. It just means work on your story, make sure it's performance-based, make sure that you're willing to accept all the factors we mentioned earlier, that the deal may look differently, not because something is wrong with the company, it's just because investors also have to do things just wearing a different lens, right? Basically, the way we operate or the way we've been doing this the past year and a half is that we were really working on a differentiated deal flow basis. When we go to events, I was at the Web Summit, for example, I did not walk around to see all the startups that were exhibiting. Instead, I went and I tried to go to the side events, the ones that were really based like on specific countries or specific regions. And the conversations there were, I'm not going to say more interesting, but they were more the ones I was hoping to hear, right? Where founders get together, they speak about issues from the same market, for example. I went to a meetup for, like from founders from the Balkan countries, and it was good hearing these founders speaking about the same challenges and them understanding that we're not alone, right? So the same thing can happen to all of these, I would say, emerging markets. And most importantly, just for investors as well, to be able to just widen their deal flow, like the way they source these deals, trying to engage with networks of these, like specific countries, specific ecosystems, to try and just get deal flow that may not look very shiny in the beginning, but this is where you really find the companies that could make a difference, the companies that would really stand out and actually have the potential of becoming outliers. So I think that's how we operate and for founders, they just have to always work on their stories and be open to co-work with the investors rather than just, take it as a relationship of please fund me and I'll let you know in a few years whether things worked out or not,
Yeah. Interesting. Yeah, I guess most founders as well think that due diligence processes are like a standardized manifesto and that they need to
Yeah.
follow. And this standardization issue is it's basically, as I mentioned earlier, intimidates those entrepreneurs. But
Yeah.
when we're speaking about standardization, what are the implications on standardizations on these startups as well? Like, is that a hurdle? Is that a challenge for them, basically,
Yeah, of
having
course.
standardized due diligence processes?
You can't standardize, right? I mean, this requires for both parties to be as dynamic as possible. That doesn't mean we would skip asking certain questions, but for example, if I know the company operates in a country where things are not as structured as one would think, instead of asking them for audited financial statements, I would ask for bank statements, right? Instead of asking for any complete, like I would just ask, for example, like revenue, like basically proof of revenue. So your ask becomes different rather than you not asking the question to begin with. And that's where investors have to just act in a more dynamic way. And at the same time, the startup has to also think, I am in this market, this is a commonly asked question. If I can't have it, what else can I provide, right? Take that initiative in trying to basically provide documentation before you're asked. And if you wait until you're asked, just make sure you're prompt, make sure you're responsive, make sure that you provide everything with absolute clarity, right? Because again, as Sally mentioned earlier, I mean, the faster the startup realizes that this whole process really sets you for the future fundraisers, right? It's not just for this one. Asking you to clean your cap table, asking you to do this or this or this. It's all part of let's clean up things now. The earlier, the better. Because the longer you wait, then everything becomes more complicated, more costly to fix, right? So the earlier both parties realize they're really working together and trying to make this work. Now, not all, I mean, we've had companies that made it up until like 90% of due diligence and the deal fell through, but it was mostly mutual, right? It's either just certain outcomes did not like meet expectations, or just you realize that this is not the right fit, right? It could still be a really interesting company. This could be a good investor, but it's just not the right fit. So as long as the due diligence process remains to be dynamic, and then it's open and it's and it's mutual, like it's really mutual effort, and it's all towards making this company investable at the moment and for the rounds to come.
Definitely. Absolutely. I was actually going to ask Sally, have you ever used alternative data sources in lieu, for example, of audited financial statements to assess a potential investment or transaction? Or whether it's local payment flows, other metrics, customer metrics, etc.
Always, always. I think audited financials is a dream for VCs. We don't actually see it even after we invest, let alone before we invest. But I think one thing that Ghadir kind of said that sums things up very well is that, and it's not even having to do with being in an emerging market, but every deal is unique in its own way, right? And what you spend time DDing from one deal to another, like differs and varies significantly, right? It's a lot of it is part of actually building the conviction, right? So we've seen deals where we haven't looked. I mean, I shouldn't be saying this a lot, but we haven't looked at financials even very deeply, just because we know that's not relevant in this particular thesis, and that's not what we're underwriting. We have other deals where really majority of our conviction had to do with what is driving growth in terms of the revenue model, what are the growth drivers, how are the unit economics improving, because that is what we're underwriting for that stage of the company. So it is very, very unique. And part of it is VCs will build up that view on what they need to DD as part of the process. But I would say smart founders also nudge VCs in the right direction, right? So today, if you're a founder and you're pitching that in the next 3 years, I'm going to be the number one player in the market, I'm going to have 50% market share, you're almost leaving it a bit too open for me to know what to look at. So I'm going to start to look at everything, right? Because I want to start to form my view around what is it that I'm underwriting in this round. Is this a pre-seed round where I'm underwriting more of product and team, or is this seed where I'm looking at real customers and real traction, retention, etc.? And so I've seen founders that actually pitch the story very well and almost guide you towards what you want to focus on, saying, you know what, in the next 3 years, we actually want to move from, 40% of our revenue being service-led to actually being product-led. It's like, okay, now I know exactly what to look at in my DD. So being very, very succinct in your story and what you're trying to accomplish with this round also helps, I wouldn't say dictate, but at least shape what investors look at in their due diligence.
Yeah, thank you. I also wanted to follow up with, do you think different sectors might have different metrics that you would look at? For example, if you're looking at a tech company, agricultural company, and energy company, this might fluctuate and be flipped around.
Definitely. And I'll let the guys kind of also tackle this as well, but it also very much differs per sector, but also it differs, I would say, with the investors' history investing in this sector, right? So for us, we have a very long history investing in fintechs, right? It almost comes second nature. We know exactly what to look at, but also who to pick up the phone and call and ask what, right? It's very different from when we did our first cybersecurity deal or our first agri-tech deal. So the history of the investor itself and what they've kind of built kind of expertise around in terms of sector is also, I would say, affects how the DD process goes.
Yeah, I guess take notes, everyone watching. I feel like you kind of broke so many barriers when you're speaking about DD right now, because most Sudanese entrepreneurs, at least, fear due diligence. They feel like there is no alternatives for audited financial statements, for example, although they are necessary, but there are other priorities that investors usually ask about. I think, Sina, I also want you to comment on that part. What do you think Sudanese entrepreneurs, or at least the entrepreneurs in our region, a region that's marked with fragility, could improve to basically increase investor confidence?
Well, I think, first of all, one thing I already mentioned earlier, it's that credibility starts with transparent communication, right? So I think that still remains valid. But picking up on what both the other panelists also said, I mean, I think what is also very critical is that capacity building in investment readiness from like the development perspective is key, I think. And I would say, especially maybe impact articulation, meaning like investor communication. I mean, not necessarily because, the entrepreneurs lack capability, but because they need support to translate their operational reality into formats that I would say investors can assess. Right. So, for example, this is also something GIZ in our project. What we have done, we supported selected SMEs to become eligible to investors without forcing them into models designed for stable economies. And I think another point I would like to mention. I mean, I already mentioned it earlier in a way. I think entrepreneurs should frame resilience as a value proposition. I mean, again, the ability to operate under extreme constraints, to adapt supply chains, relocate operations, or pivot business models. For me, it's not a weakness. I think it's rather an evidence of managerial strength and adaptability, and I think that should be communicated clearly, coming back to this transparent communication. And I think also something which entrepreneurs can do is, I mean, yeah, of course, leveraging networks, what I mentioned earlier, but also, I guess, I think investors also respond strongly to basic operational discipline. Ghadir, Sali, maybe correct me if I'm wrong, but that was at least, my impression. Like even simple accounting systems or clear team roles and documented decision-making, decision-making processes, I think significantly improve confidence.
That's actually, I think it wraps up our discussion when we prioritize transparency, we prioritize discipline, and it goes far beyond audited financial statements. I think it's more about the founder's commitment, even exposure to risks such as Sudanese entrepreneurs in our situation right now. Resilience should be awarded. I think it should be recognized. And I would just like to end our discussion by saying thank you all for your valuable insights. I hope everyone here has benefited from our discussion and took back all your, insider information, let me call it that, into due diligence processes from across the MENA region and drawing back to Sudan as well. Thank you all. I would like, if you'd like to say final remarks, feel free to before we wrap up.
Thank you guys for putting this together. Really appreciate it.
Thank you.
Thank you, Shahad. Thank you, Ahmed. Thank you, everyone. And thank you, Sali and Sina. It's been a pleasure speaking alongside you.
Maybe just one thing. I think needs-based support, flexibility, and close engagement with an sorry. Oh, sorry.
Bless you.
So again, needs-based support, flexibility, and close engagement with entrepreneurs are not compromises in such contexts. I think they are the only way to keep viable businesses investable in times of crisis. And with that, I also want to thank 249 and my co-panelists. It was really a pleasure taking part today.
Likewise.
All right. Thank you, everyone. Have a nice evening.
Thank you.
Thank you.
Bye.